Well, hello and welcome everybody. It is the 12th of March, Tuesday. Joe with you here. Let's jump into a market roundup. I'm going to give you my 2 cents on trades. You guys know how this works. I'm also going to share the trades with the community. Take responsibility for the outcome. First thing I'm going to do is break down the meaningful news of the day. As always, take a look at the charts and see if we can take advantage of them and then share trades with the community.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Moving into the market analysis, we actually had kind of an outlook going into the weekend that we were going to consolidate or even possibly pull back. And for a little bit there, it looked like we were going to, but these markets are looking like they're going to be more of a consolidation than they are a pullback. Now, it is only Tuesday, so we'll see if things change. Let's jump straight into the daily news. The CPI was in line with expectations. Now, that was the CPI overall, but the core was higher than expected. So the market reaction is bullish, still expecting rate cuts later this year. June expectations versus May, these actually started in March, folks. The expectations of the markets were for a rate cut as early as March. That moved to May, and now we're pushing it down the road till June. Regardless of what's going on with the interpretations of the CPI, or should say inflation, these markets are just strong. Where we're sitting is pretty decent. So how do we finish overall? Well, the Dow added over 0.5%, the S&P over 1%, and the Qs, or the NASDAQ itself, over 1.5%. So it was actually a pretty good push higher today off of the last Friday going into Monday, which is a little consolidation, but very strong, still above that 20-day moving average in at least the Q and the SPY. So let's continue forward when it comes to the advanced decline line. 52% advancers, 44% decliners. Above below the 50-day moving average is 65.35. So not a lot of movement, nothing really gained or lost when it comes to advanced decline and or above below the 50-day moving average. Where my main focus is for all the markets is any sort of retracement price action or retracement to support levels. So any sort of pull is met with another push. So here's a pull. It looked a little bit more bearish on Monday, thinking we'd go lower, and then boom, here we come out on Tuesday. Could this easily turn back down? The answer is yes. It's the overall box that I built that I'm actually most focused on because that is going to be my overall month-to-month outlook. Taking a look at the NASDAQ, you're going to see it's pretty much the exact same thing, maybe a little bit more volatile. That's how this works when it comes to tech. This is the level that I'm kind of focusing on. It's a little bit more shallow than you'll see my SPY line, but I can actually open this up a little deeper, and I'm not afraid to go to the 428 level at all because I know we got a lot more volatility in this sector. I know there's a lot more performance, especially with communications. We've got a lot of traders that are probably taking profits on a lot of really strong moves in just communications itself, let alone tech. So don't be afraid if you see these huge drop below that 20 and above that 50 in this next corrective action. Do not confuse that with a bearish move because it is not. It is just a little bit more, range or ability for traders to take profits in a very, very strong outperforming sector. And what you'll see in the heat map is pretty much green across the board. When you do have an announcement like the CPI that comes out, it's a little hotter than it was supposed to be, but when everybody sentiment-wise is comfortable with it, you're going to get this. And I don't know why I'm going through and highlighting every one of these boxes. I don't have to, because it isn't until you get down to real estate and energy, utilities, and basic materials, this area over here, which has been predominantly weak for a while, that's the only area that you actually see any sort of significance when it comes to brown or red. Now, I'm going to say brown or red because these are not dark red. This is just a little bit of hesitation, maybe a little bit of a sell-off, maybe a defensive play that has now been second-guessed. And that's about all I'm going to chalk today's movement to. So what does that mean when I take a look at my monthly outlook and my market outlook, I should say, for monthly and weekly? Not a lot of change. The only thing I did is I might have gone from a 0 to a +1 up to a +2 again. And it's pretty obvious why. It's because we did have a little bit of I was expecting more of a consolidation, but if you take a look at the last couple of days specifically, it's this move that shows, hey, boy, we might actually be pushing up and extending into new highs. Now, that doesn't mean we will, but my fears, or I shouldn't say fears, but my worries of a consolidation or pullback, my 0 to +1 outlook is now changed to a +1 to +2, because it was very quick for these markets to take a look at a CPI that was showing expansion. Understand, folks, please do not confuse the fact that the consumer price index is increasing. We did increase expectations from the previous, which came in line, but the core itself rose a little hotter than expected. Doesn't say that, oh, it's out of control, but inflation is definitely still there, but it is controllable. Or according to what the Fed minutes or what the Fed said, they seem pretty comfortable with it, and the markets absolutely agree. So let's take a look at some of the trades I have out there. I've got a couple of bulls sideways and a couple of bears for you. And this is just preference. This is just things that are underperforming and outperforming and things that have kind of been left alone. I don't want to look any deeper than that because I truly really want our traders to, these are suggestions. If you use them, great. If you don't think you have to. But let's break them down a little bit. This is Capital One Financial. This was a sideways trade for me for a few weeks, but there's something that I'm seeing in it that that raises a little bit of an eyebrow. If this is something you have not taken sideways yet, that's fine. You could still play this out as long as you're attaining to this resistance level, about the 141 level. But what I'm starting to see is a little bit of a surge or an increase to the upside, and this might possibly break out to become more of a high base breakout to the upside. Not a whole lot of participation yet in the volume, but this is in a really good sector, an outperforming sector that's actually gained a little bit of heat. If these markets can sustain their bullish outlook and this financial sector continues just to bleed higher, this could break out. So I moved this from a sideways to a possible bull trade. I'm not going to shoot for the 150 area or anything like that, but maybe a targeted calendar spread, targeted butterfly, some sort of a bull call spread, showing that, hey, once this thing gets above the 142 level, it might stay there for a week or so. This might be a pretty cool sideways to up trade. Moving over to the sideways, we've got Goldman, and Goldman has been sideways for quite some time. I keep coming back to the fact that, hey, it's been in a pretty good range up here, although this range is not considered tight. We're at about 397.50 down to 382.50. What's that, $15? Right. So we got a good range here. However, there is a pretty good advantage to be taken if you can open these ranges up. Whether you want to do some sort of a butterfly here, that might prove difficult, as this thing has a pretty large range. It's going to be a little bit difficult because it is super volatile, but it has definitely stayed sideways overall. So as a suggestion, it might be something that could be worth playing if you're looking for something like that. The only problem that I run into with Goldman Sachs is it's in a very overperforming sector right now. Financials are showing some good strength. However, this really hasn't participated like we've seen a lot of those financials, not yet. But you do have the ability in the range to maybe take advantage of something and not worry too much about, hey, once it gets above those levels, if it breaks up or it starts to fall apart. For you guys that want to play those condors, you kind of keep this a little bit tight just in case this does break above or below one of those levels. It really depends on the credit that you can receive and if it's worth holding this. It is a really good sideways chart, but it doesn't have to be played that, especially if the risk doesn't make sense. Let's move over to our bear. This was on my bear list from a little while ago. I think the most intriguing part about this trade is I did find a little consolidation, or I should say corrective action, below a previous low that was set at the beginning of the year here in January. It's a little bit more of a slow play. I would allow this to go maybe up to the 20-day moving average. You could see this revisit, I would say, 166 might be an area. So not quite a turnaround immediately, but something sideways to down. You could do some sort of a credit spread. I don't know if I want to target all the way back down to 162, because if the markets continue to stay high or at least consolidate, this might hold up. But if we do roll over and push down, I don't see this having a problem rolling back towards that support of 162. So Credit spread sideways to lower. I wouldn't do anything too aggressive. This is not a -3, -2 trade. This would be more of a 0 to -1 trade. But your big line in the sand is going to be this 160 mark. If it can stay below that, it could be a pretty good trade sideways to down. And that's about all I want to do with that. Now keep in mind, folks, the overall outlook, and it remains the way it has been for a while, is we are still in a bullish market. This sentiment's still bullish. Glass half full, especially with the CPI number that seemed to be met with optimism versus fear, although it was absolutely higher than expectations, and even with a revision to in line was still an increase from previous. What we have is a super optimistic market. Lots of traders are very confident and comfortable, which is absolutely going to make these markets move higher. So whatever you're looking to do in the shorter term to the bull side is actually going to work. But that's fine if you want to play some sideways. I think that might be a cool place to maybe hedge some of your positions out, or some of your exposure if need be. What we do have left economic-wise is the PPI, retail sales, jobless claims, manufacturing, consumer sentiment. Yep, those are all going to come out. Based on sentiment, whatever those numbers are, which we've just seen with the CPI, just depends on how you see it. And unless there's something out there super major, I'm going to continue to stay glass half full. As always, folks, check earnings potentials. Regardless of your bias, it's best just to be mindful of it. Thank you guys so much for joining me. We'll see what happens tomorrow. We'll talk to you next time. Bye, folks.